Confident? If you own apartments in Washington, D.C., here's the headline for June. Rents jumped 1% last month. That's twice the national rate. But on a year-over-year basis, the city is still down 4.2%. That gap tells you exactly where pricing power is heading. I'm Shafiq Hirani, MBA, CCIM, with RE/MAX Distinctive Commercial. I work with apartment owners and investors across the DC metro and around the country on acquisitions, dispositions, and portfolio strategy. This channel exists for three reasons. First, to give you a clear, no-fluff monthly read on the DC rental market. It's the same data I use with my clients. Second, to help you turn that data into better leasing, renewal, and investment decisions. And third, to be a resource you can come back to when you're weighing a move on your portfolio. So let's get into the June 2026 numbers. Start with the numbers that matter. The median rent across the district now stands at $2,113. That's up 1% month over month, but down 4.2% compared to a year ago. For owners, that's a mixed signal, and an important one. The monthly gain says demand is firming heading into peak leasing season. The annual decline suggests the market is still working through the rent resets from the last 12 months. If you're underwriting renewals or new leases right now, model against this trajectory, not last year's comps. Here's a stat that doesn't get enough attention. 5 months into 2026, DC rents are up 1.9% year to date. At this same point in 2025, they were up 1.8%. That's effectively the same seasonal pace, which tells me the underlying leasing cycle is normalizing. The annual decline you're seeing isn't a market in free fall. It's a market that has already absorbed its correction and is now growing on a lower base. That distinction matters when you're setting concession strategy. How does DC stack up against the rest of the country? Last month, the national rent index rose 0.5%. DC came in at 1%. That's double the national pace, ranking number 25 out of the 100 largest cities. Peer cities posting similar growth, Jersey City and Baltimore both at 1%. The takeaway, month over month, DC is outperforming. Year over year, DC is underperforming. The nation is down 1.5%, while DC is down 4.2%. So if you own here, you're inside a market that fell harder but is now bouncing back faster. On absolute pricing, DC remains a premium market. DC ranks as the 15th most expensive large city in the country. A one-bedroom runs about $2,081.20. A two-bedroom, $2,144. For context, the national median is $1,211 for a one-bedroom and $1,365 for a two-bedroom. DC sits 53% above the national median, putting DC in roughly the same price tier as Oakland and Los Angeles. That premium is your moat. It's also your ceiling. If you're chasing the top of the market, watch what happens in those peer cities. They're your real comp set. Now zoom out to the broader metro. The Washington, D.C. metro median is $2,161, meaning the district proper is actually 2.2% cheaper than the metro average. And metro-wide rent growth is holding up better than the city itself. Metro is down 2.1% year over year, while the city is down 4.2%. Translation: the suburbs are absorbing demand, and the urban core is losing. If your portfolio spans the metro, that's a tailwind. If you're concentrated inside the district, plan for more competition from suburban products. Inside the metro, the spread is enormous. Landover is leading the entire metro in annual growth, up 11% year over year. On the other end, Annandale is the weakest, down 5.7%. Price-wise, Lorton is the most expensive submarket at $2,766, and Glassmanor is the most affordable at $1,505. If you're acquiring, refinancing, or repositioning, these submarket spreads are where the real strategy lives. The metro-wide average will hide the opportunity. 3 things to walk away with as an apartment owner this month. 1. The monthly trend is positive. Demand is firming. Hold the line on asking rents going into peak season. 2. The annual numbers still reflect last year's correction. Be realistic about renewal increases. Aggressive bumps risk turnover in a market that hasn't fully reset upward yet. 3. Submarket selection matters more than ever. The metro average masks an 11% to -6% spread. Know exactly where your assets sit on that curve. Now I want to hear from you. Drop a comment below and tell me what you're seeing in your buildings. Are renewals holding? Are concessions creeping back? Is your submarket moving with the metro or against it? The more questions you bring, the more useful these monthly updates become for everyone watching. I'm Shafiq Harani with Remax Distinctive Commercial. That's the June 2026 read on the DC rental market. I'll see you next month.